Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and/or financial topics. Take a look and see what people are sharing. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com. It's a website. I do midweek updates. I do question and answer sessions, answering whatever questions people have on the weekends through a Zoom call that people can attend. We've got a discount coupon code that is active, May Day coupon code, saves you 50% the first month and can save you even more money on a yearly membership if you decide to switch over, even if you're a current monthly member. Coming down to myself, we've got uranium versus silver, uranium versus the S&P 500, uranium versus copper, and uranium versus gold. Let's look at the charts here. So, does this look bullish or bearish? If you take this at face value, guys, you have a downtrend, you have a double bottom, you have a breakout of that bottom, and then you have a retest. And technically speaking, this is an ideal entry point, right where we're at right now, with uranium versus silver ratio, ideal entry point. Uranium versus the S&P 500, you have downside momentum. You get a double big bottom pattern. You break out of the pattern, you do a retest. We are doing the retest. This would technically be a great time to accumulate uranium based off of the technicals of what we're seeing in this ratio. Uranium versus copper, we get a bottoming pattern. We break out of the bottoming pattern. We come back and do a retest from the top side down. And again, this would be a great time to accumulate uranium, according to this ratio. And then uranium versus gold. So we've got a huge underperformance in the 2008 crash, where gold preserves your purchasing power and a lot of commodities fall off the face of a cliff. That's what the cliff looks like. Then we bottomed out, which took many years. We are starting to turn higher here, which has broken a horizontal resistance level. And now we're doing a retest back to that horizontal resistance support level. This too would suggest that this is a good buying opportunity for uranium versus gold. So my takeaway here is, over time, I think that this is a good long-term entry point for uranium based off of all of these ratios that I look at. And that is a non-biased approach. That's just using some ratios and the under and outperformance of commodities against other commodities. This is Nat Gas versus Dow Jones Industrial. It's same spot as last time. So last bull market for commodities, it started in the bottom here at 1998-99 in this falling wedge where we squeezed up. We broke out of that wedge, retested back, and that's kind of what uranium was doing in all those other ratios. So we retested backwards, and then we went way up there, and we're at a much higher level for natural gas versus Dow for a period of time. We created a shoulder, a head, a shoulder, a neckline, and then the breakout lower into another big consolidation period from 2008 onward. We recently broke out of this pattern in 2021, very similar to the breakout in 2000. We've pulled back, and we're right where the circle is, in my opinion. And I think we are going to have an outperformance of natural gas versus Dow Jones. Now, some people will say nat gas could rise or Dow Jones Industrial Average could decline, or you could do both. I think both will occur. I think we'll get a decline in the Dow Jones Industrial Average, and I think natural gas will go up. That's what I think. Here's some more ratios, because I love ratios, and they tell us stuff about historical relationships. Crude oil and the S&P 500 ratios, S&P 500 versus oil fractal overlaid on top of the new path. We have an extended right shoulder going on right now. So this is crude oil versus the S&P 500. Last bull market started in 1999. We had crude oil outperform the S&P 500 all the way up to the peak of 2008, where we broke all the way up here. Then we broke down. We consolidated here upwards, just like a lot of the technology companies are doing right now. They've got the same big selling pressure move, consolidation like SMCI, some of the semiconductors. Then we crashed, and now we've got a double bottom going on. You come in, this is your lead in for the double bottom. We are putting in the right hand side of that second bottom, right where we're at. Now, if you flip this around, S&P versus crude oil, we should be seeing a topping pattern. This was the last fractal of last bull market from 1987 all the way up to 99 peak for the S&P 500, where crude oil bottomed. And then we came all the way back down. Crude oil was expensive in 2008, 2010, 2011. This is expensive crude oil down here. And then you can see we hit a bottom of crude oil in 2020. And then this cycle just repeats. So 2020 is analogous to 1999. That was the beginning of the commodity bull market of last time. 2020 is the beginning of the commodity bull market, I think, this time. And then we have a shoulder, a head, and a shoulder. And the neckline's right here where we bounced. So we're putting in a big shoulder pattern, in my opinion, where we'll eventually roll over. I am surprised at how high the S&P 500 has gone so far, but I don't think it matters. Crude oil is going to eventually outperform the S&P 500 given these historical relationships that I'm seeing in history. And crude oil is incredibly cheap against everything, and I'll show you more charts showing that. So here's NASDAQ versus the oil ratio, which I think is really interesting. Oil is cheap and NASDAQ is expensive. Patterns are repeating. We have a shoulder, head, shoulder, and then the neckline in 1999. That's when the commodity to stock ratio bottomed and started to come back up. Was at 99, 2000. 2002 is when they lowered interest rates to save the NASDAQ and S&P and potentially the economy. But crude oil outperformed all the way to the bottom of 2008. Then it came on up. We have a nice surge higher, and this was the beginning of the NASDAQ, where we should be buying the NASDAQ here in 2010, 2011, 2012. NASDAQ outperformed from that period forward all the way to a peak of 2020. That is where I swapped my stock. I sold it in 2019, my technology shares, and bought a whole bunch of oil and gas and other commodity companies, uranium. And now we're coming on back down. We've made a counter move, which is, again, very similar, to, almost exactly the same as last bull market of commodities, is the same fractal pattern that's occurring right now. We have an extended, we'll call it a right-hand shoulder if you're looking at it, left-hand shoulder if you are the person. But right-hand shoulder here, and we had an extended right-hand shoulder here too. It's the same frickin' setup. So in my opinion, we've got an overvalued NASDAQ and undervalued crude oil, and this will eventually turn. I'm not stating that it has to turn immediately. What I am stating is that the fractal's there, the setup is there, and that I think that this is eventually going to turn over at some point over the next however much time. I don't know the time. And that this is going to come all the way back down to levels down here. Again, if that occurs and you're in oil equities, you will be rich. With any sort of money buying it on this shoulder here, you will make obscene amounts of money. And if you have selected the best companies and bought at this shoulder area, so if I purchased a bunch in 2001, 2000 on this right-hand shoulder, I would have made gobloads of money coming and selling somewhere in 2007, 8, 9, 10, wherever it is. But probably in 2008 would have been the best, obviously, choice. A lot of those companies and some of the commodity companies during this time frame went up between 10 and 100x, depending on where you purchased it and your ability to hold. But that's what I'm seeing there. Here's another one. Dow Jones Industrial Average to Oil Ratio. Last time at this spot we turned. Not saying we are turning this time, just stating history. Flipped oil to Dow Jones Industrial Ratio as well. A false breakdown is definitely possible here for a slingshot move later. So what we're seeing here is a big move up, coming on down, and this is the same spot as this circle here. Circle, circle. It looks like a very similar fractal too. This run up is the run up here, the blow off head, the blow off head. We have the pull back, and then come back up, and we're right at the circle. And I think this is a great opportunity to accumulate crude oil over the next 6 months, 3 months, whatever it is. If we get a false breakdown, perfect. Perfect. Oh, and I've got more here. This is crude oil versus Dow Jones. So Dow Jones coming up. This is a 1, 2, 3 hump consolidation, false breakdown in 2020, the move higher. And we have another falling wedge or squeezing wedge. And this is what it looks like here. So the false breakdown was there. We came on up. We squeezing again. We could probably have another false breakdown and then a move higher. Very, very similar here with that. To oil ratio and the most recent ratio. So looking back at history, when we look at all of history going back to 18, a very cheap price for oil is anything around 30x. For the most of history, the gold to oil ratio has sat between 10x and 30x. It says gold is expensive relative to oil, the higher this is, and gold is cheap relative to oil, the lower this is. You can see this huge spike in 2020 where I bought the living crap out of oil equities, and I was using this knowledge right here to make that determining factor. This here is a one-off anomaly in history. They say the COVID-19 pandemic, a slowdown in economic activity, and the debt-driven stimulus package by governments are all factors in the recent gold rally. And also, they stopped the economy where they had oil prices go to basically zero or negative. That was your opportunity of a lifetime to ride this back down. Right now, we could potentially be going through another slowdown, which I think we are. And we could see this come back with vengeance. The oil ratio dropping dramatically over time. But that might be 6 months to a year out. Might take some time to get there. And that's what everybody thinks. Just because this is cheap doesn't mean it has to be expensive immediately. It might take time. And this is what I'm seeing here with the gold to crude oil ratio. I'm seeing a shoulder, head, shoulder, which is a topping pattern of gold versus crude oil. So what we're seeing is a bunch of head, shoulder, head patterns in crude oil against a variety of asset classes. Gold, Dow Jones, NASDAQ, S&P 500. We're seeing squeezing and tightening when you reverse crude oil as the first one. So I think that crude oil is setting up over the next however many months, 6 months maybe, a potential bottom or maybe a false breakdown or something like that could occur. And then we're going to slingshot higher. That would be my guess. Oil prices ignore bullish inventory and physical market changes. So the sentiment is poor, and that might be due to what the market may be seeing in the future. Could be recession, could be slowdown, could be something in the market that is bothered. The fundamentals today, if you were to look at the fundamentals today, oil is undervalued. Oil of a fair value oil price would probably be in the mid to high 80s, given the data and the inventory levels. But the market is looking ahead and it's saying, wait a minute, there's something out there. At least that's what it's saying now. And that's why oil potentially could be going lower in the short term. Here's crude oil versus the gold ratio. I've also did that, so I flipped it over. We've got a squeezing wedge. So let's go back to the first setup. The first setup is a big consolidation in the mid-1980s. Big consolidation, 1, 2, 3. We bottomed in 99. We broke out. That was the first move. We retested back, and then we went all the way up into 2005, and then eventually 2008, which is the peak. We peaked in 08 against gold. Crude oil did. We came all the way back down. We created another 3-hump consolidation just like this. We've broken out of the consolidation, and now we are consolidating again on top of that in a falling wedge. Falling wedges are bullish to move upwards. In this particular pullback, we've pulled back 63% in this ratio currently in the most recent pullback. The last pullback that occurred in 2001, oil pulled back 53%. So we've already pulled back more on a percentage basis than we did last bear market when we went through the recession of 2001. So I think it's a similar setup. And I think we're going to go to this upper end up here eventually, where crude oil is going to become expensive in relationship to gold. And someone could say, well, what's going to cause that? They need a narrative. They need someone to make up a story that they can believe. I don't know the narrative yet, but my guess is that we are going to hit, they're going to create stimulus money, or they're going to print more money, and they're going to put oil into a shortage, and then oil can't respond fast enough. And if there is any sort of supply constraint in oil, it's going to amplify the move. It's going to amplify it to all get out. So it's a combination of more money printing and the situation that America is with its debt, the value of the dollar. So that's going to come with money printing. It could potentially come with lowering of interest rates. It may have a negative reaction to lowering of interest rates right off the bat. It might fall a little bit lower and then turn as the dollar weakens. And that's kind of where my head's at with oil. Oil versus gold. Breaking, Gary Gensler releases statement suggesting he may leave the sect. Conveniently, he's leaving right before the SMCI and NVIDIA round-tripping accounting fraud blows up the entire market. Probably has to revise a textbook here. So this is Stonk's value. It says nowadays people don't remember that MSTR crashed 99% during the dot-com bubble because it was basically a fraud. First chapter of Financial Shenanigans. Talking about MSTR. Are we going through a similar situation where he's leveraging the heck up in crypto, and crypto eventually goes down and MSTR crashes 99% again? I don't know. It's possible. It is possible. Trump will be very positive for U.S. oil industry, says Oxy CEO. So obviously she is maybe working with Trump, and maybe this was leaked out. Something's very positive there for whatever reason. Here's Tether's CEO suggests he may shift Tether's focus to developing markets like Argentina rather than Europe if regulatory issues are too complex. Simplify, Tether doesn't want to be transparent with its fraudulent criminal crypto in Europe, so we'll take advantage of Argentina. Yeah, there's some shady stuff going on all over in technology and in crypto, in my opinion. There's a ton of shady stuff going on. I don't want to touch any of it. That's my opinion. U.S. stocks outperformance relative to the rest of the world has reached extreme levels. 75-year high in U.S. stocks versus rest of the world. It's as expensive as it's ever been. This is not going to end well, guys. It's not going to end well. Peter Lynch quote. So let's hit the quote here. So often there is no correlation between the success of a company's operations and the success of its stock price over a few months or even a few years. In the long run, there's a 100% correlation. And that correlation is the success of the business's operations versus the stock price. This disparity is the key to making money. It pays to be patient. So what is he looking at? He's looking at the disparity between the stock price and the value of the business. And then you have to be patient. You buy it when it's undervalued and you wait for the correlation to link back up again. So the correlation is 100% correlated between the success of the business and the stock price. And what you do is you buy it when there's a mismatch between the stock price and the business value. It's that simple. But it's hard to put to practice for most people. U.S. gasoline storage hit the lowest level for the first time of the year in the last 5 years. Yeah, we've totally got a demand problem, even though U.S. gasoline storage is low and oil's low. But is something coming? Is a demand destroying event coming where they stop oil demand somehow? I don't know. Maybe. Maybe. Here is ETF XOP outperforming crude oil. You can see the positioning here. XLE is already in stride against oil. And PSCE is the small cap ETF. It is earlier in the process of outperforming crude. If you want crazy setups, I have them on the website if you're looking for a lot more leveraged plays than these. So XOP is breaking out here. We're probably going to do a retest move back against it, and then we'll see if we take off. We've got XLE already breaking out against crude oil and working its way on up. You can see that fractal is very similar to the fractal that gold had and silver had before it broke out. So this looks really good. And then we've got the same similar fractal in PSCE versus crude oil. We are up against resistance and we haven't quite broken out yet. And this has a long way to run for the small cap ETF. Small caps look fantastic here. They look absolutely fantastic. I love it. Absolutely love it. Coming on back. Gold is on sale measured in Bitcoin and silver's on sale. Okay, I already talked about that one last time. So we're going to end it there. Give me a thumb up for the content, guys. Subscribe to the channel. Subscribe to the website. I'll talk about all those oil companies. You guys already know them if you're part of the website that are highly leveraged. There's some other ratios that look really good for the companies that I like. And I'll show you guys what those ratios look like there. They look really, really good. But that's what I've got for today. And we'll catch you next time. This is Finding Value.